Everyone's asking the same question right now. Rates are up again. Is the property market about to crash? That assumption is exactly how people may get this wrong, because interest rate rises don't automatically crash property markets. They change who can buy, what they buy, and where the pressure shows up first. I'm Tien from Invest and Grow Property. This will be short and straight to the point. First, why did rates rise? The RBA doesn't raise rates randomly. They raise rates when inflation stays too high. Australia's latest CPI came in at 3.8% over the year, still above the RBA's 2 to 3% target band. But the breakdown matters. According to the ABS, housing was 5.5%, food and non-alcoholic beverages 3.4%, recreation and culture 4.4%. This isn't just a petrol spike or one-off shock. Inflation pressure is broad-based, which means the RBA can't ignore it. This is where the two-speed economy shows up. One group of household is feeling every rate rise immediately, while another group still has buffers, savings, and assets. Interest rates are a blunt tool, but they don't hit everyone equally. Now, a lot of people are saying, but the Australian dollar was rising, shouldn't that stop rate hikes? Normally, yes. A strong dollar makes imports cheaper and can help cool inflation, but at this point, it was not enough. Even with the dollar strengthening, domestic inflation, especially housing, services, and discretionary spending, stayed sticky enough that rates still went up. So how do high rates actually flow through property markets? This is where most commentary falls apart. Higher rates don't hit property all at once. They flow through in stages. Stage 1, borrowing power drops. Buyers can't borrow as much. That slows demand first in expensive investor-heavy areas. Stage 2, behaviour changes. Buyers may hesitate. Sellers hold back unless they have to sell. Days on market stretch, but only in the weaker pockets. Stage 3, cash flow pressure appears. Low yield, high holding cost properties start hurting. That's where forced selling risk shows up. Not everywhere, only where assets were weak to begin with. This is why Australia is not one market. It's markets within markets. Now, the 3 mistakes that investors sometimes make. Mistake number 1, waiting for a crash, where most crashes never arrive. Good assets usually pause, then move again. Waiting often causes more hurt than necessary. Mistake number 2, buying cheap instead of resilient. Mistake number 3, ignoring cash flow. One last risk you need to understand, supply. When rates rise, demand naturally flows down the price curve. That's why people suddenly say, units make sense now, cheaper entry, higher yields. And short term, that actually can look right, but here's the risk. When you get a wave of unit approvals, those approvals eventually turn into completions. Too much supply hitting the market doesn't cause prices to crash, it causes stagnation. That's how you end up with a property that grows a bit in year 1, then goes sideways for the next 2 or 3 years. Units can perform, but only in supply-constrained, owner-occupied locations. Now zoom out. The bigger supply picture matters more. Build Skills has confirmed a looming shortfall of around 140,000 construction workers by 2029. That's only 3 years. If demand stays the same or even softens slightly, prices don't fall. They stay supported. That's basic supply and demand. And guess what? Regions are the most exposed to this. We're already seeing it in the migration data. Recent regional movement data shows around 2.5% increase in people moving from capital cities to regional areas. That remains elevated in places like Geelong in Victoria and Fraser Coast in Queensland. These aren't speculative markets. They're lifestyle-driven, owner-occupied locations benefiting from migration. So here's a summary. With rates up, the overall market probably won't perform like last year. Some capital city pockets may slow and some assets will stall. But the right regions, the right affordable segments, supply-constrained locations can still outperform over the next 1, 2, 3 years. Just remember this, affordable does not automatically mean it'll go up. That's where most investors get caught. If you want help applying this to your situation, please reach out. No pressure, just clarity. Thank you and see you in the next one.